Welcome to the Red Cloud Research Roundup, hosted by Red Cloud Financial Services. It is August 26th. Vanadium-focused company Strategic Resources has had an exciting year as they ramp up for the fall. The Red Cloud research team has been following the story closely, as they have deemed it worthy for coverage initiation. Timothy Lee, mining analyst, is here to provide us further details on the news. Rounding out the episode, mining analyst Alina Islam is here to share a take on Pilbara Minerals' acquisition of Brazilian developer Latin Resources. So with that, Tim, over to you.
Hello, and thank you for the warm welcome. This week, we initiated coverage on Strategic Resources Inc., that's SR, on the TSX Venture Exchange, with a buy rating and a $1.70 target price. Strategic's goal is to build a vertically integrated operation with a mine and downstream process plant to produce iron ore, pellets, and other precursors for green steel, with its operations located in Quebec. They're going to start off with the midstream part of this plan by building a pelletizer plant that would source third-party magnetite concentrates to produce pellets particularly formulated for the green steel industry. There are a few key reasons why we like Strategic. First, the company is focused on inputs for green steel, which uses direct reduction or electric arc furnaces rather than traditional blast furnaces. This is the growing sector of the industry, particularly in North America and Europe, and the products fed to these furnaces have different specs, typically higher purity, than those fed to traditional blast furnaces. Second, by focusing initially on the pelletizer plant, the company has a more manageable project, but still with robust economics that would give the company good cash flows to then build the larger operation. According to the PEA announced earlier this year, the pelletizer plant comes with an initial capex of US $470 million, more manageable than the $1.5 billion capex of the overall vertically integrated operation from the 2023 feasibility study. As well, it comes with less execution risk, as it is a simpler operation than the larger plan. And the PEA economics for this plant were robust, with a post-tax NPV 8% of US $957 million and a 25% IRR. Third, the company has unusually strong investor and government backing. Just over 81% of the shares are held between Orion Resource Partners and Investment Quebec. As well, Ross Beatty and the Lumina Group and the Cree First Nation are significant shareholders. The company in its current form was created last year through a reverse takeover by BlackRock Metals, which was owned by Orion and Investment Quebec, of the original Strategic Resources, which was a public Lumina Group company that came with a second project in Finland. Finally, hand in hand with the strong government and community support, the company's vertically integrated operation is fully permitted. The project is essentially shovel-ready, pending project financing. They do need one amendment to a permit because the pelletizer, as now envisioned, would have a higher throughput than that initially proposed. They have gotten written notice from the Quebec Ministry of Environment that this should be acceptable, but they do need the final official stamp of approval. Looking forward, the company has several key catalysts. First, that permit amendment, as well as a final agreement for hydroelectric power. Second, overall news related to project financing. They have already assigned a lead bank for the debt financing, and they plan to have this arranged early next year. As well, they are in talks with magnetite suppliers and steel manufacturers, both about locking up magnetite supply for their pelletizer plant and looking at potential investment agreements. Longer term, we look forward to the start of construction and ultimately building that vertically integrated operation and then advancing the Finland project as well. So to reiterate, we are initiating with a buy rating and a $1.70 target. That target is primarily based on a model for the pelletizer in which we use conservative assumptions, both by assuming a higher initial capex and by using a conservative assumption on what is called the DR pellet price premium. Our assumptions are a bit closer to the current price, although we do note that that has some upside, as it's near the low end of the range over the past few years. We note the company's stock is down from last year. We believe this is due to downward pressure on iron ore and steel prices because of lower demand from China. However, we think this presents a good buying opportunity to get into a company focused specifically on products for green steel, which is the growth area of this industry in North America and Europe. Alina, on to you.
Thanks, Tim. This week, I wanted to talk to you about Latin Resources. We have a tender rating on the stock, and I will note that Latin is not a banking client. So in mid-August, Latin Resources entered into an agreement with Pilbara Minerals, where Pilbara will acquire 100% shares of the company in an all-stock deal, with Latin shareholders receiving 0.07 of a Pilbara share for each share held. So at the time the deal was announced, this essentially implied a value of 560 million Australian dollars, or 20 cents per share. If approved, the deal would mean that Latin shareholders would own about 6.5% of Pilbara Minerals, which owns the Pilgangoora hard rock lithium operation in Western Australia, and they are one of the top 5 spodumene producers in the world. Now, Latin's board, which owns 5% of the shares, as well as its largest shareholder that owns about 8%, have confirmed their intention to vote in favor of this transaction, which is expected to close by the end of this year. In a letter to its shareholders, which was sent out following the announcement, management stated that the rationale for this merger are the current challenging capital markets and the issues they could have raising the funds needed to develop the Salinas lithium project in Brazil. So with 1.6 billion in cash, Pilbara already has the means to fund Salinas 250 million capex spend and bring the project into production by 2027. Now, Pilbara, they bring expertise to the table, as the Pilgangoora ore body shares similarities to the Colina deposit. So we do think this is a good transaction and a good deal for both companies. We had always viewed Latin as one of our top picks, given the scale and the quality of the Salinas project. And we believe that Salinas' chances of development are much higher in the hands of a large global pure play hard rock producer like Pilbara, who has enhanced capital markets abilities. So overall, this is a positive development for Latin shareholders, as it provides them with immediate access to a cash flow generating asset in a challenging lithium market. And, there is further upside here, especially once Salinas comes online. So we do expect shareholders to vote in favor of this transaction and for this merger to go through. I would just like to finish off by saying that it is likely we will see more consolidation in the lithium space as development stage projects require funding, and large players in the industry with their strong balance sheets pick up high quality assets to add to their pipeline. And that's all I had. Thanks for tuning in.
Thanks for listening to the Red Cloud Research Roundup podcast. We hope you enjoyed this dive into recent notable mining news. Remember, you can join us every Monday for new episodes, and as always, you can head over to redcloudsecurities.com to read all of the research reports discussed, for all Red Cloud Securities free research reports, and to sign up to our email list. That's it for this episode, and see you next time.